Welcome to this explainer. Okay, so today we're unpacking a fascinating and, frankly, a kind of hilarious paradox in modern finance. If you've been watching the markets lately, you've probably noticed a really strange trend. The folks spending hours poring over balance sheets and calculating discounted cash flows, yeah, they're getting completely left in the dust by people making trades based on, literally, internet memes. It feels totally backwards, right? Well, we're going to break down exactly why these reckless strategies have actually been succeeding, and much more importantly, how you can protect yourself when the music inevitably stops.
So that brings us to the central question we're exploring today. Why exactly do the dumbest investors win? It's not just pure absurdity, although it certainly feels like it. There are actual market dynamics at play here. We really need to understand the underlying mechanics that temporarily reward behavior that, historically speaking, would wipe out a brokerage account in a matter of days. And to really get a handle on that, we need a guide who perfectly proves the rule.
Meet Dave. Dave represents a very specific yet incredibly common demographic right now. He's been actively trading for exactly 2 years. Now, in Wall Street years, 2 years is basically the equivalent of being a toddler who just discovered fire. But hey, Dave's portfolio is up 13% year to date. He recently hit it big on some obscure crypto meme coin, and his confidence is at an absolute all-time high. Dave's hobbies include watching The Wolf of Wall Street on repeat, telling girls at the bar about emerging biotech companies, and zinning. So naturally, based on all of this, Dave feels it's pretty safe to say he's got what it takes to be a full-time trader. But his ultimate risk management strategy? Prayer. Seriously, this total lack of actual risk management is the ticking time bomb sitting right at the center of his recent success.
To really understand how a guy like Dave actually makes money, you've got to zoom out for a second. Take a look at this massive 715% figure. That number represents the returns of the greatest bull market in history. Think about it. We've been in a 17-year bull market. The S&P has essentially been on an absolute bender since 2009. Over the past 17 years, pretty much anything you threw your money at would have likely generated a positive return. So it's the environment itself doing the heavy lifting here, not the sheer brilliance of the investors.
And this brilliantly illustrates the psychological engine driving Dave's rock-solid confidence, the Dunning-Kruger effect. In the context of our explainer today, think of this as the financial markets version of Darwinism. It perfectly explains why inexperienced people suddenly think they're the next Warren Buffett, why genuinely smart people often second-guess themselves, and why Dave firmly believes that shadowy market manipulation is literally the only reason his trades ever go wrong. Since 2020, if you were sitting on the left side of this Dunning-Kruger curve, which is right where Dave sits, you would have actually significantly outperformed the S&P 500. It's wild. You basically mistake the rising tide of a 17-year bull market for your own personal genius.
Now, this creates a really bizarre split in the financial world. On one side, you have traditional investors who are focusing on fundamentals, fair valuations, the boring stuff. But on the other side, the recent winners, they're doing the exact opposite. What's their strategy? Well, they're buying companies trading at 650 times earnings. They're riding trends that make less sense than pineapple on pizza, and they enthusiastically pump their bags to anyone with a pulse. It's an entirely irrational approach that has, paradoxically, generated some serious alpha.
To perfectly punctuate just how absurd these current market trends are, consider this highly satirical quote attributed to Warren Buffett in our source material. "Why buy Apple when you can buy Fartcoin?" Obviously, Buffett didn't say that. It's a complete joke. But man, it captures the exact sentiment of the modern retail market perfectly. I mean, why invest in a fundamentally sound, historically dominant tech giant when you can just throw your cash into a highly volatile internet joke and potentially see a massive, immediate return?
Okay, so how does a literal joke coin actually outpace a tech titan in a roaring market? Well, the secret ingredient here is beta. Beta is basically a measure of the volatility of a stock when you compare it to the market as a whole. And retail investors absolutely love volatile, high beta stocks. In a market that just constantly goes up, beta acts as this incredibly powerful multiplier.
Let's look at Amazon, for example. It has an assigned beta of 1.33. That just means it's essentially 33% more volatile than the broader market. So when the market rises 2%, Amazon jumps 2.66%. That right there is the multiplier effect retail investors crave. But listen, the math doesn't care about your feelings. If the market drops 2%, Amazon falls 2.66%. Beta is a brutal double-edged sword. In a downturn, that exact same volatility that made you feel incredibly rich will violently accelerate your losses. It turns what should be minor market corrections into total portfolio devastation.
When the market is soaring, a high beta portfolio makes our guy Dave feel like the next George Soros. He's looking to book a table at Nobu to celebrate his sheer genius.
But what happens when the market goes down? Well, that high beta portfolio suddenly feels the brutal, unforgiving effects of gravity. In a bear market, Dave isn't dining at Nobu anymore. He's seeing if the local payway is hiring. His high beta portfolio just made him the next tragic trending post on the Wall Street Bets forum.
When you stretch this out over a longer timeline, the consequences of this high beta leverage become fatal. Check this out. Day 1, Dave calls his broker, slightly lies about his net worth, and gets approved for options trading. Fast forward 3 months, Dave is now leveraged to the absolute max on out-of-the-money Tesla calls. His strategy is literally buy high, sell higher, while his wife is left wondering why 13 grand is suddenly missing from their savings account. Then fast forward 3 more months. The macroeconomic environment shifts, the Federal Reserve decides to hike rates. Instantly, Dave's over-leveraged portfolio drops 67%, and his wife's new favorite hobby is Googling how to divorce a man who calls himself a market wizard. This is exactly what happens when you substitute high beta leverage for actual solid risk management.
Like all great benders, the 17-year market run must eventually come to an end. So how do you actually prepare for a potential market downturn? Our source humorously presents 2 options. Option 1, sit on cash like Buffett has been doing lately, but as the source notes, that's boring, and you're definitely not looking to compound at the risk-free rate. That brings us to option 2. Just continue to go all in and then simply blame others when the markets inevitably reverse. You can blame Fed Chair Jerome Powell, you can blame politicians like Donald Trump, or you can just blame the mysterious market makers. The satirical point here is that retail investors feel they must blame someone because accepting personal accountability just isn't how they think investing works. But for those of us wanting to actually survive the turn, true risk management means acting now. It means stress testing your portfolio against rate hikes, actively lowering your beta exposure before gravity kicks in, and diversifying away from these momentum trades so you aren't forced to blame anyone when the tide finally goes out.
Which brings us to our final thought for this explainer. The next time a friend brags to you about their massive 10-bagger return on the latest meme coin, I want you to stop and ask yourself, are they a genius or is it just a bull market? Because as we've learned today, absolutely everyone feels like a genius when the tide is rising. But true investing survival? That requires a strategy that actually works even when the tide goes out. So keep learning, keep questioning, and for the love of your portfolio, manage your risk.